Welcome to the Macro Minutes Investment Show here on the Samaritan Financial YouTube channel. My name is John Burrell. I'm the strategy manager, and I'm here with the IT administrator, Chadwick. How you doing?
Yeah, I'm doing fantastic. How are you today?
I'm doing good, ready to get the show started here on this Tuesday afternoon after the markets close. We got a great show lined up for you today.
All right, well, I'm excited. Let's jump right in.
Michael Burry just sent a warning to artificial intelligence companies over this latest craze with AI. Should investors be worried? Well, let's get right into that right now. Talking about NVIDIA, let's look at their price to earnings ratio. Essentially what that is how much a company is total price for all their shares, like if you would go buy a business, how much you would pay for that business versus how much it earns in a year. If you would buy NVIDIA as a whole, like you would just buy a normal business, like a Citgo station down the road or something, you'll be paying 44 times what it earns in a year. Now that is very expensive, but we have seen evaluations higher. Speaking of higher evaluations, let's look at Tesla, which is another Michael Burry short that he has right now. He says it is ridiculously overvalued. Well, let's see, Michael Burry. Is it ridiculously overvalued? Tesla trailing PE ratio is 294, and I would agree it is ridiculously overvalued. Now, you could say, okay, but all these signals and evaluations, markets can stay irrational longer than you can stay solvent. That's kind of the running saying in markets. So let's look at our signal and our trend process on these two stocks and see how they really equate to a real investment strategy, not just off of your assumptions. We'll start back with NVIDIA here on the chart, and NVIDIA is currently $181.46 a share. Now, our trend level for NVIDIA is $138.82. So we are currently bearish. Our strategy is currently bullish. It is currently bullish on NVIDIA as right now, unless it breaks that trend line. So yes, it may be overvalued and its PE ratio is really high, but we're still bullish on NVIDIA here. Now, if we go over to looking at something like Tesla on our charts, it's TSLA, and we can see it's on the NASDAQ here, so we're going to pull that up. Tesla is currently at $429.24, and the trend line for that, or the trend level, is $355.84. So Tesla is still bullish trend by our model, so we're going to keep it to the bull side here on these two stocks. Now you may say, well, who is Michael Burry? Michael Burry is who called the financial crisis of 2008 and made a bunch of money, but since then he's been wrong on some things, and we're going to say it's not quite time to get short on these stocks. Moving back to our charts here in just a moment, we're going to talk about the rest of the market as a broad sense and talk about where the S&P 500, the crude oil, the gold, all the different markets that are major markets that we look at on a day-to-day basis to see where they stand in this market cycle.
All right, let's go.
We're going to start with the or with the S&P 500. We use our futures as a proxy for this. The current level for the S&P 500 is 6,847. Trend level for that is 6,146. We are currently bullish on the S&P 500. Moving to the NASDAQ, it's basically the same movie. NASDAQ at 25,623. The current trend level for that is 22,232. So we are way above trend on the NASDAQ. A lot of bullish stuff here to look at until you look at oil. Oil is our first bearish chart that we've pulled up here, with our trend line being at $71.83. But crude oil is at $58.62, looking for gas prices to stay on the cheaper side, which is always a good thing. Now, looking at gold, it's probably our bullish thing that we have on the charts and that we'll see, other than silver. But gold currently at $4,242 an ounce for gold. Trend line is down there just under 3,000 at 2,949. So very bullish on gold. It has had phenomenal returns. Quickly moving on over to silver at $59 an ounce. Its trend line is all the way down there at $33.37. So very bullish on the precious metals. Now looking at Bitcoin, it's currently had a rally and it's almost getting close to that trend level. We have been bearish on Bitcoin like we've been bearish on oil. You can go back to past episodes and look, but we're getting close to that key investment level. Bitcoin's currently at $91,845. Our trend line is at $94,055. So we look to buy above the trend level and sell below the trend level. And there's mainly bullish things here, but Bitcoin, crude oil, two of the ones that we're bearish on. And that is our market recap for our key investing levels.
Yeah, okay. Sounds great.
Yeah, so we're going to keep it moving here. Now, right after reviewing what the market's done is a perfect time to look at what our strategy has been doing and tell you about how you can invest in our strategy. So I had a question on this not too long ago where people were saying, well, this says Collective 2, you guys are Samaritan, what's really going on here? So we are a research and development firm. I am the strategy manager and Chadwick is he's over all the IT stuff. He's our IT administrator. So he builds the infrastructure for us to run our program software and to do our research on. It's the backbone of what we run here with our algorithms and everything of the sort. So we do the research, we build and take care of the signals for our strategy, but Collective 2 offers this service to you. So we are the research firm, we work for Collective 2. Collective 2 is the one that brings you the product to market. With that being said, our strategy is currently down 1.3%. Its max drawdown is right around 7%. As you can see on the dashed line, it is the S&P 500. The green is our strategy. We are right at the same performance as the S&P 500, and this is the total replacement of the S&P 500. It's the SP 500 total replacement strategy. What we aim to do is have similar returns as the S&P 500 until drawdowns happen, like massive drawdowns like happened in COVID. When that happens, we look to cut our losers and while the market settles back down before we get back in. We will tend to outperform the market as things change and we have drawdowns and big market moves going forward in the future. But if you're interested in this, there's a link in the description below. It has a lot more information and details in it. For the first 3 months, you can get it for $5 a month for the signals, if you just want the signals, and you can place them if you want to or not. But if you want to automate the process, it's an extra $55 a month, and you can completely automate this process and follow our strategy. Now we're going to get into our educational corner. This week we're going to talk about odds and probabilities, and we're going to recap a little bit of last week, but all this stuff is tied together. These are our key investing concepts that we want to share with you of like what all we put into our thought process and our methodology for our strategy that we offer. So we just want to get into this a little bit, not go too deep on it, but we do want to give you enough to make you think of, okay, how should I invest, and not go off of my guts or my feelings or my thoughts, but really go off of a strategy that works over the long term.
Sounds good. What do you got for us?
All right, so let's get into the graph here we have. So this graph is basically demonstrate the law of large numbers. And what the law of large numbers is with once you do something once or twice, it doesn't really show the average outcome. But if you do something multiple times, like 200 times, for example, then you're going to really get to the average of the outcome that is desired or theoretical. In this chart, it shows a die being rolled 200 times. So the average of the throws is on the left hand side here, and at the bottom here is the number of throws. Now if you throw a die the first time it might land on a 2, it might land on a 3, and these different colored lines are different attempts of rolling this die 200 times. So if you roll a die once or twice or 3, 4, 5, 6, 10 times, you may not get the average of the theoretical, and the theoretical is 3.5, meaning that over 200 rolls, you're going to get the same number of 1s, the same number of 2s, 3s, 4, 5s that's going to show on the die. So as you throw the die, you may get a 1 come up, and then a 2, and then a 4, and then a 6, and then a 5. But over time, if you add up all of those numbers that the die lands on, divided by how many times you throw it, over time and over many throws, it'll equal 3.5. This is important because you want to understand the odds and probability of investing, and how can we relate this to investing? Well, this can really show us our edge. So if you say, for example, every time you roll a 1, you make $10, and every time you roll a 2, a 3, a 4, a 5, or 6, you lose $1. Well, because those over time will come up the same amount of times, the collection of 2 through 6, losing $1 for each of those, you would lose $5. And because 1 comes up the equal amount of times as the other rolls, you would make $10. Now your profits minus your losses, $10 minus $5 equals $5 profit. So if the game with your odds versus your probabilities versus your odds or your payout, you take away your profit, take your profits, subtract your losses, and that's your expected outcome for the game. So that tells you if the game that you're playing is profitable or not. Now we're using this die throw to give an easy example to demonstrate whether a game is profitable. And not necessarily a game, but just investing. You want to know how many times you're going to be profitable over how many times you're not going to be profitable, because not every trade you're going to win. But in your strategy, now we're not talking about how to build the strategy here, we're just talking about you have a strategy and you're going to look how it performed over a long time frame, over many trades or investments. So if you have this strategy that has an advantage, you need to know what your payoff is versus your percent of winning. Now what that's going to tell you is how much of your bankroll, because everyone has a finite amount of money, how much of your bankroll do you need to invest in order to optimize your returns based on your advantage in the markets or in business in general. So position sizing, like we talked about last week, is so important, because if you take 100% of all the money that you own and say you roll that die, if it comes up on a 2, you've lost everything. And this can be true even if you don't use 100% of all the money that you have. Say you get a 2 and then a 3 and then a 4. You've lost 3 times in a row. So there's a percentage of your bankroll or the money that you have that you should invest that you don't lose everything. And there's a percentage that if you go over that, you lose everything. So really in investing, it is key to optimize your returns without pushing it too far to where you lose all your money. So if you start with something too small, then you're leaving money on the table. If you start with something too big, you're losing everything. So it's really about optimizing your position sizing. It's the most important thing that you can control. And we talked about how to get that number last week with the Kelly criterion. Now you can look that up. You can use the Kelly criterion to get the optimal value that you should invest in whatever endeavor that you have. In this case, for us, we invest in S&P 500. We have that S&P 500 total replacement strategy that we use. And we use this probability, odds, and statistics to know how much we should invest in the S&P 500 so we don't lose all of our money, but we still make the most we possibly can. And with that was our educational corner. What is your thoughts?
Yeah, I think it's really important to know that position size and take good choices, make good choices, I should say, and look for the sweet spot. You know?
Yeah, look for the sweet spot. And it's really about managing your risk. And you can't manage risk after you take it. You can only manage risk before you take it.
Right.
So if you get in your car when you're in the wreck, you can't decide to fasten your seatbelt. You can only do that before you get in a wreck. So it's really about risk management is really not a thing. You can't manage something that is unknowable or uncontrollable. You can only manage your allocation to it, or how much you allocate. Like if you're always in a car, you're taking more risk than if you're only sometimes in a car. So really choosing how much time you're in a car will depend on how much risk you're taking. And if you're, going to a job to make money, you want to make sure you're getting enough money for the risk that you're taking when you get in the car.
There you go. Well, I'll tell you what, Johnny. Quick question for you. Do you know why investors are loving cows right now?
Why are they loving cows?
Well, it's because every time they hear the market moo, they hope it's bull.
They hope it's bull. And that's your sign the herd is moving. So follow the trend. It is your friend. And we'll see you next week.
All right, stick with it, guys.